Most people think taxes are just a bill. That is the first mistake. The second mistake is worse. They think the tax code was written to treat everyone the same. It was not. It was written like a giant reward map. The government wants certain things badly enough that it will pay people to do them. It wants jobs, it wants housing, it wants energy, it wants capital moving into places that keep the machine running. So it does not only collect money, it redirects money, it punishes some behavior, it rewards other behavior, and if you never learn the difference, you spend your whole life paying retail for wealth. I have spent my life watching people obsess over returns while ignoring structure. That is how intelligent people stay stuck. They fight over an extra 2 points of return in the market while letting 10, 20, sometimes 30 cents of every dollar bleed out through a structure that was wrong before they ever made the money. You can call that a tax problem. I call it a positioning problem because the code is not asking one question. It is asking two. Did you earn money? And did you earn it in a way the government wants more of? Those are not the same thing. That is the whole game. That is the whole mother line. If you miss this, the rest of the conversation is noise. The IRS is not randomly handing out favors, it is buying behavior. And the people who look rich to you from the outside often got there faster because they understood that the state will subsidize what it wants repeated. I want to make this brutally simple. You can live as a pure payer, or you can live as an allocator. A pure payer earns, reports, and sends money out. An allocator earns, roots, owns, deducts, compounds, and only then pays what is left. That identity flip changes almost everything. Most people never make it. They stay in the first identity because it feels cleaner, safer, more normal. Salary comes in, tax goes out, they call that adulthood. I call it the expensive version of adulthood. Once you see the code clearly, you stop asking, how do I avoid taxes? That is the wrong question. The right question is, what behavior is the code paying for? And can I position myself there honestly, legally, and intelligently? That is a very different mindset. It leads to a very different life. I want to give you a few mechanisms. Not because jargon is impressive. Jargon is usually camouflage. I want to name them because named mechanisms are easier to remember under pressure. And this subject only matters if you can still think clearly when real money is involved. The first mechanism is what I call the reward map. The reward map is simple. Every major tax break exists because the government wants an outcome badly enough to subsidize it. That is the definition. The government does not wake up in the morning trying to make your life easier. It wakes up trying to keep the economy funded, employed, housed, and supplied. So the tax code becomes a price sheet for preferred behavior. Build something useful, hire people, put capital into productive assets, create housing, produce energy, expand capacity. In those lanes, the code becomes generous. Outside those lanes, it becomes blunt. That is the harsh judgment most people never absorb. They think taxes are a moral contest. They are not. They are a behavior contest. If you work in a lane the code does not subsidize, you can still make money. But you should not be shocked when you pay full freight. The code is not insulting you. It is signaling what it prefers. That alone should change how you look at money. Because a tax saving is not a side benefit. A tax saving is a return. If you save $10,000 in taxes legally, you do not need the market to make $10,000 for you. You already kept it. That is a real return, with no need to pray for sentiment, multiple expansion, or a lucky quarter. Most people spend years learning how to invest. Far fewer learn how the system itself rewards investment. That is why they work hard and still feel like they are carrying a backpack full of bricks uphill. Now, the reward map gets more interesting when we move from theory to the second mechanism. I call the second mechanism the net income machine. The net income machine is the reason business ownership changes the tax conversation so dramatically. The definition is straightforward. Employees are usually taxed on gross income first and then live on what remains. Business owners usually calculate tax after legitimate business expenses reduce income to net. That sounds boring. It is not boring at all. It is one of the most important differences in the financial life of an adult. If your income enters your life as a wage and stops there, your flexibility is narrow. Money shows up already exposed. If the same dollar enters through a real business, it enters a different legal and economic environment. Now, there may be deductions for the ordinary and necessary costs of producing that income: marketing, software equipment, professional services, advertising, travel tied to business, vehicles tied to business use, even portions of housing when used properly and legitimately for business purposes. That is not a loophole. That is architecture. And architecture beats hustle more often than people want to admit. Here is a number that wakes people up. The code allows up to $5,000 of startup research and investigation costs to be written off, and another $5,000 for organization costs, assuming the business legitimately launches. That means a real business can begin life with $10,000 of immediate deduction potential before most people even understand what game they are in. Then, if the business grows and qualifies, there is the 20% qualified business income deduction. 20%, read that again in plain English. You do not just try to grow income in the right structure. The code may let you shield a meaningful slice of that income simply because it came through a business lane the government prefers. That is the net income machine. And the real example is not always glamorous. It does not have to be Amazon, a small consulting practice, a content business, a service company, a niche e-commerce operation, a local trade business, a digital agency. The scale changes, the principle does not. Amazon is only useful as a giant illustration of a small truth. For years, one of the largest companies in the world was able to report very low federal income tax relative to its earnings because it reinvested aggressively into warehouses, equipment, property, servers, research, expansion, and all the machinery of growth, depreciation, deductions, R&D, incentives, a structure aligned with the code. People look at that and feel outrage. I look at it and see a lesson. The code rewards productive reinvestment more than passive complaining. That does not mean every business is good. It means productive business activity sits close to the money spigot of the code, and that creates a hard divide in the real world. One person earns 100,000 lives visibly and pays like a machine. Another person earns 100,000 through a real operation, reinvests into the engine, deducts legitimate costs, compounds inside a better lane, and reaches the next decade in a stronger position. Same income. Different game board. Now let me make the judgment sharper. If all of your income is designed to arrive naked, you will be taxed like a spectator. If your income arrives inside a productive vehicle, you have tools. That is why so many people feel that the rich are playing by different rules. In one sense, they are not because the rules are secret, because they bothered to stand where the incentives are. The third mechanism is what I call expense reclassification. Expense reclassification means an expense that is personal in one life can become partially or fully deductible in another life when it gains a legitimate business function. That is the definition. Notice the word legitimate. That word matters. This is where foolish people get themselves in trouble because they hear one sentence about tax strategy and suddenly imagine that every dinner, every trip, every car, and half the roof over their head is now a deduction. That is not discipline. That is fantasy. Fantasy is expensive when it meets an audit. But disciplined people understand something powerful here. The tax code does not only reward giant acts, it also rewards the routine operating costs of productive activity. So when a real business exists, spending that would have been dead, spending in a personal lane may become lower after tax in a business lane if it truly serves the business. This is where average earners can improve their financial life without needing to become billionaires. A laptop purchased for real business use is not the same as a laptop purchased for pure consumption. Software tied to client work is not the same as random subscriptions cluttering your card statement. A vehicle used meaningfully in business is not the same as a vehicle existing purely for vanity. You start to see the pattern. The wealthy are not always spending less. Often they are spending through a more intelligent pipeline. The same dollar is either consumption or productive fuel, depending on the structure around it. That difference sounds subtle. Over 10 years, it is not subtle at all. It is a canyon. Now we move to the fourth mechanism. This is where the average person starts to realize the game is much larger than side deductions and startup write-offs. I call this one the phantom loss engine. The phantom loss engine sits at the heart of why real estate has such a powerful reputation in tax planning. The definition is brutal and beautiful. Real estate can appreciate in the real world while generating paper losses in the tax world. That contradiction is the engine. And once you understand it, you stop seeing real estate as merely a place to live or a rent check arriving once a month. You start seeing it as a machine that can produce cash flow, equity growth, and deductions at the same time. That combination is rare. It is why serious capital keeps coming back to the asset class. Here is the simple math. A rental property can generate rent against that income. The owner may stack mortgage interest, property taxes, insurance, repairs, management fees, and one of the most important items of all, depreciation. Depreciation is one of the strangest gifts in the code. A building may appreciate over long stretches. Yet the IRS still allows the owner to deduct depreciation as though the asset is wearing out. So the owner may collect very real rent while reporting very little taxable income, or in some cases none. After deductions, that is a phantom loss, not fake in the legal sense, real on the return, but not always matched by economic pain in your pocket. That is why I call it an engine, because it keeps converting one kind of reality into another. Now, the number from the source material is a good one because it shocks people on a $1 million property. A cost segregation study may generate more than $200,000 of additional deductions in a single year through accelerated depreciation concepts. $200,000, some investors create a first-year deduction larger than what many families earn working all year. And here is the part that really bothers people who never studied the structure. Even if debt financed the purchase, the depreciation does not care where the purchase money came from. The code does not ask whether you paid cash before allowing the deduction. That is a giant clue. Debt is not just a burden when used intelligently. It can be a lever inside a tax-favored asset. Now, none of this makes a bad deal good. A foolish property purchased at a foolish price with foolish financing is still a foolish deal. The tax tail should not wag the investment dog, but the mechanism is real, and the harsh judgment is real too. Most people buy housing for shelter. Some people buy real estate for shelter, cash flow, equity, depreciation, and optionality. Those are different universes hiding behind the same front door. This brings us to the fifth mechanism. I call it the equity escape loop. The equity escape loop is what happens when an investor uses real estate not just as an income asset, but as a long-duration compounding vehicle. The definition is simple. You buy the property, collect cash flow, claim deductions, let tenants, help service the debt, build equity, borrow against that equity without triggering tax the way a sale would, and when you eventually want to sell, you may use a 1031 exchange to defer capital gains by rolling into the next property. That is the loop. Buy, depreciate, build, borrow, exchange, repeat. This is why real estate can feel unfair to people outside the loop, because they are measuring only one line item. Usually the price, they are not measuring the whole machine. The whole machine includes cash flow. The whole machine includes debt paydown. The whole machine includes appreciation. The whole machine includes depreciation. The whole machine includes the ability to borrow against built-up equity. The whole machine includes the ability to defer gains through exchange. When you look at all six parts at once, you understand why so many fortunes were not built by genius stock picking, but by patiently repeating a tax-favored asset cycle. There is a deeper lesson here in America. Wealth is often built not by sprinting harder, but by entering loops that work while you sleep. That is a hard sentence for the hyperactive mind to accept. But it is true. And the sixth mechanism is the most aggressive one in the source material. I call it the strategic scarcity subsidy. The strategic scarcity subsidy exists when the government views an industry as important enough to national stability that it offers unusually large incentives for private capital to enter. That is the definition in the material you gave me. That sector is energy, especially oil and gas activity tied to qualified drilling operations. Now, this is not beginner material. It is not broad, clean, universal advice for every family. It carries real risk. It often sits in private deals. It is often more relevant to accredited investors, and it absolutely requires competent professional guidance, but that does not change the lesson. The lesson is that when the state needs something badly enough, the incentives can become startling. The number here is the hook. An investor may be able to deduct up to 85% of a qualified investment in year one. Think about that carefully. Invest $100,000 and receive an $85,000 paper loss flowing through on a K1, depending on the deal structure and the tax treatment involved. That alone should tell you how serious the incentive can be. Now, how does the machine do that? First, intangible drilling costs. Labor, fuel, supplies, the messy working costs of drilling. In many businesses, intangible costs are not treated this generously. In these energy structures, immediate expensing can be unusually favorable. Second, depreciation on physical assets, equipment, machinery, wells, tangible pieces of the operation. Third, depletion allowance. In the source material, 15% of revenue may be excluded from taxation through depletion treatment, meaning the incentive is not only front-loaded going in, it may also soften taxation coming out. So look at what the machine is doing. Large deductions in the beginning, preferential treatment during production. That is not an accident. That is policy wearing a finance costume. And the harsh judgment is this: When a nation views something as strategic, the people who finance it often get treated better than the people who merely watch it happen. Now I want to slow down for one moment, because this is where shallow minds ruin themselves. Hearing that a lane is subsidized does not mean every deal inside that lane is good. Business can fail, tenants can vanish, properties can be mismanaged, energy deals can disappoint or implode. Tax benefits do not repeal stupidity. They magnify competence. That is why I do not tell people to chase every deduction they hear about. I tell them to understand the governing principle. The principle is that the code is a reward map, and the fastest way to pay less is usually not hiding income. It is building your life so more of your capital moves through rewarded behavior. That difference is the difference between strategy and desperation. Desperate people ask, what can I write off? Strategic people ask, what can I own, build, or fund that the code wants more of? One question is small. The other question changes your balance sheet. Now let me give you the identity flip more directly, because this is where the emotional shift has to happen if you want the economics to follow. If you live only as an employee, you are not failing, but you are standing in the rain while the awning is 3 feet away. The awning is ownership, not reckless ownership, not fake entrepreneur cosplay. Real ownership, a real business, a real asset, a real productive vehicle, a real record-keeping system, a real reason for the deductions, a real plan for reinvestment. That is why I said the issue is not intelligence. It is positioning. Many high earners are still poor positioners. They earn beautifully and structure terribly. So the money arrives and then leaks. It leaks through full rate taxation. It leaks through pure consumption. It leaks through assets that never become engines. It leaks because nobody taught them that the code is not a neutral referee. It is a loudspeaker. It keeps telling you what it wants. Most people just never listen. And that brings me to what I would call the operating system. If you do not build an operating system, all of this becomes entertainment. I do not want you entertained. I want you reorganized. So here is the protocol I would follow. First, stop viewing tax savings as a side issue. It is not a side issue. It is a form of return. The more efficiently you keep a dollar, the harder that dollar can work in the next cycle. Second, decide which rewarded lane actually fits your competence and temperament, business, real estate. Possibly specialized energy with real professional help. Do not pick a lane because it sounds glamorous. Pick the lane you can understand well enough to survive in. Third, create legitimate structure before creating fantasy deductions. Us without records is not a strategy. A property without underwriting is not a strategy. An energy deal without expert review is not a strategy. Structure first. Claim second, fourth. Root spending toward productive assets before lifestyle inflation eats it. This is where wealthy people quietly separate from everyone else. When extra cash arrives, average people upgrade consumption, disciplined people upgrade engines, they buy equipment that produces, they fund businesses that scale, they acquire assets that throw off cash flow and deductions, they do not just earn more, they redirect more. Fifth, stack incentives only after the base economics make sense. A terrible business with a deduction is still a terrible business. A bad property with depreciation is still a bad property. A dangerous private deal with a big paper loss can still destroy real capital. Never forget that. The code can improve a good decision. It cannot rescue a stupid 1/6. Repeat. The game is not won in one heroic year. It is won in repeated cycles. Own, deduct, reinvest, compound, own more. That is the protocol. And now I want to make one final point, because people often hear a conversation like this and think the conclusion is cynical. It is not cynical. It is clarifying. The tax code is not a fairy tale, and it is not a conspiracy novel. It is a pricing mechanism for national priorities. If you understand that, you stop taking taxes personally and start responding strategically. That alone calms the mind. You no longer flinch every time April approaches. You start asking better questions all year. Where is my income landing? What am I building? What am I funding? What am I owning? What part of my life is merely expensive, and what part of my life is productive? Those questions are worth more than most financial tips people pass around on the internet. Because the truth is simple and brutal. Most people try to get rich after tax. A much smaller group learns how to build wealth before tax pressure has taken its full bite. That is one reason the gap widens. It is not always because one group is working 10 times harder. Sometimes it is because one group keeps getting paid to do what the system wants, while the other group keeps paying full price to do what the system does not care to reward. If that sentence stings, good, it should, because this subject should make you uncomfortable. It should make you re-audit your life. It should make you look at every dollar of effort and ask whether it is entering a rewarded channel or a punished one. You do not need to become reckless. You do not need to become dishonest. You do not need to copy the exact behavior of billionaires. But you do need to stop living as though taxes are only something that happens after the game is over. For serious people, taxes are part of the game board. And the board is tilted toward owners, builders, and funders of what the government wants more of. That is not a slogan, that is the operational truth. Business can move you from gross exposure to net calculation. Real estate can turn appreciation and deductions into a double engine. Debt in the right asset can become a lever instead of a chain energy. In the right deal with the right guidance can produce tax treatment that shocks people who never bothered to study the code. Each one of those is a door. The tragedy is not that the doors exist. The tragedy is how many capable people never even reach for the handle. They earn, they spend, they pay, they repeat, and then they wonder why the numbers never seem to move as fast as the effort. Well, effort without structure is expensive income, without positioning is exposed. And taxes paid at full retail, year after year, are not just a bill. They are a signal that your life may be organized around earning, but not yet organized around keeping and compounding. That is the knife edge of this whole conversation. The IRS is not literally trying to make you rich, but it is absolutely willing to make certain forms of productive behavior cheaper. The people who understand that will keep compounding with a tailwind. The people who do not will keep rowing into the wind and calling it normal. I would not call it normal. I would call it optional. And once you see that, you cannot unsee it. At that point, the responsibility becomes yours. You can stay a pure payer, or you can become an allocator. You can keep arriving at tax season empty-handed, or you can start showing up with structure, assets, deductions, and choices. You can keep asking how to survive the code, or you can finally ask what the code is paying for and whether you have the courage to move there. Because that is the real dividing line. Not rich versus poor, not aggressive versus conservative. Not lucky versus unlucky. It is builders versus spectators, operators versus bystanders, people who let the code price them, and people who learn how to let the code fund part of the journey. That is where the real game begins.